Hello, everyone, and welcome to the Deep Dive. Today, we're tackling a massive question, one that really impacts the entire global stage, the future of European
It's a
competitiveness.
huge topic.
Absolutely. And we're breaking down a recent, pretty comprehensive report that dissects Europe's economic challenges, but also its opportunities.
Right.
And our goal, really, is to cut through the noise, pull out the most important nuggets of knowledge, and give you that shortcut to being, well, genuinely well-informed.
And this isn't just some, academic thought experiment.
Mm.
This report is incredibly robust.
Mm-hmm.
It's got contributions from a really wide array of experts, plus a dedicated European Commission team behind it.
This was grounded.
Deeply considered, yeah. It offers not just detailed analysis of the problems, but also concrete, actionable policy advice.
Mm.
Ideas on how Europe can navigate this increasingly complex global environment. It's a blueprint, really.
Okay, let's dive right in then. The report kicks off by highlighting a fundamental shift. It says three external conditions that were kind of tailwinds for Europe's growth after the Cold War.
Right.
Well, they're now rapidly fading.
Yeah, and it's striking how fundamental these shifts really are.
Yeah.
I mean, they represent a complete recalibration of Europe's global operating environment.
Right.
And what's maybe even more crucial is how these external pressures are, revealing and frankly exacerbating existing internal vulnerabilities, things Europe already faced.
Okay, let's unpack the first one, global trade. For decades, that rapid growth in world trade was a huge benefit, right? Especially for Europe's export-heavy economy.
Yeah, definitely.
The report points out between 2000 and 2019, international trade as a share of GDP in the EU just soared from 30% up to 43%.
Big jump.
Huge. Contrast that with the US, they only saw a rise from 25% to 26% in the same period. So Europe really, really leveraged globalization.
It did.
But now, the IMF projects world trade growth at a much slower pace. We're talking 3.2%. Compared to that 4.9% annual average we saw between 2000 and 2019. So what does this actually mean, on the ground for Europe?
Well, it means those easy gains from just ever-expanding global markets, they're gone.
Right.
For an economy so reliant on exports,
Yeah.
on global supply chains, this slower growth translates directly into, harder competition for market share.
Makes sense.
Potentially fewer opportunities for European companies to grow overseas, and just a general tightening of the economic landscape.
Mm.
It forces a kind of fundamental rethink about where future growth is actually going to come from.
And then there's the really dramatic story of cheap energy. The report highlights the huge cost of losing that relatively inexpensive Russian pipeline gas.
Yeah, that was huge. It accounted for, around 45% of the EU's natural gas imports back in 2021.
Wow. And the impact has been severe. I mean, Europe essentially lost more than a year of GDP growth.
A whole year's growth. Yeah, while redirecting massive fiscal resources. We're talking billions and billions to energy subsidies and building new infrastructure for importing liquefied natural gas, LNG.
The LNG terminals.
Exactly. And even now, the pain is palpable for businesses.
Yeah.
EU companies still face electricity prices maybe 2 to 3 times higher.
2 to 3 times.
And natural gas prices 4 to 5 times higher than those in the U.S. That's a staggering competitive disadvantage. Just huge.
Absolutely. And finally, the third fading condition, geopolitical stability. For a long time, that period of stability, largely under U.S. global leadership, it allowed the EU to pretty much separate its economic policy from security concerns.
Could just focus on trade, the single market.
Exactly. Focus internally.
Yeah.
But now with Russia's aggression against Ukraine, deteriorating U.S.-China relations, rising instability in Africa, which is a source of critical commodities,
Yeah.
Europe just can't afford that luxury anymore. It truly needs to integrate security considerations right into its economic planning.
Precisely. That luxury of focusing almost exclusively on economic integration without deeply factoring in hard security, it's over.
Yeah.
The report starkly notes aggregate EU defense spending is currently only about 1/3 of U.S. levels.
1/3.
And look, this isn't just about military might in the traditional sense. It's about supply chain resilience, protecting critical infrastructure, ensuring access to vital resources in what's become a much more unpredictable world.
So these aren't just external shifts.
No, they're profound challenges.
Yeah.
And they expose these existing vulnerabilities within Europe itself.
So, okay, if the external landscape is shifting so dramatically, what about Europe's internal foundations? The report moves from those global pressures to a deep dive into Europe's internal challenges, particularly in innovation, productivity, and skills. And this is where it gets I think, truly revealing.
Yeah.
Let's start with the productivity puzzle and the digital lag. The report points out that EU labor productivity, it had converged pretty well, right? Up to 95% of US levels by 1995.
It was catching up.
But since then, it's actually fallen back below 80%. And since 2015, average labor productivity growth has been really sluggish, just 0.7%. That's quite a concern, especially when you think about the demographic outlook.
It is a huge concern because this isn't just some abstract number, right?
Yeah.
This lagging productivity is happening just as Europe's workforce is projected to shrink significantly
Yeah, you mentioned that earlier.
by nearly 2 million workers each year by 2040. So on this current path, GDP growth in the EU is expected to basically stall completely.
Wow.
And the report pinpoints a core reason for this widening gap with the U.S., Europe's failure to really capitalize on the first digital revolution, particularly in adopting and integrating digital technologies across all sectors.
So it's not just about inventing tech, but using it.
Exactly. In fact, if you actually exclude the tech sector itself, EU productivity growth over the past 2 decades would be, broadly speaking, on par with the U.S.
That's fascinating.
It shows it's a foundational weakness in digital adoption across the board.
That's a really powerful distinction. And it's not just about that broad digital adoption. The report highlights Europe's struggle in being at the forefront of breakthrough tech.
Right.
Like around 70% of foundational AI models developed since 2017, they originate in the US.
70%.
And when you look at cloud computing, these three massive US cloud provider, the hyperscalers they call them,
Yeah, because of their sheer scale.
they account for over 65% of both global and European cloud markets. Meanwhile, the largest European cloud operator holds just a tiny 2% share in its own market.
2%. It's incredible.
And even in emerging fields like quantum computing, none of the top 10 global tech companies investing heavily in quantum are based in the EU. This isn't just a small gap, is it? It feels like a chasm. It suggests Europe isn't building those next-gen foundational technologies.
And it's also about a persistent failure to scale up what Europe does manage to innovate.
Ah, right, the scale-up problem.
Yeah. Think about this statistic. There is no EU company with a market capitalization over EUR 100 billion that has been created from scratch in the last 50 years. None.
In 50 years.
None. Compare that to the U.S., where all 6 companies currently valued over EUR 1 trillion were created during that exact same period.
That's stark.
It is. And Europe faces this huge gap in later-stage financing, venture capital. In 2023, VC investment in the EU was just USD 8 billion.
8 billion, that sounds low.
It's dwarfed by the USD 68 billion invested in the U.S.
Wow, okay.
And this financing gap is clearly pushing talent away. Between 2008 and 2021, a significant number, 40 out of 147 European unicorns, those startups valued over $1 billion.
Right, the unicorns.
40 of them chose to relocate their headquarters abroad, mostly to the U.S., seeking better growth opportunities, better funding.
So the ideas might be there, but the ecosystem to grow them isn't.
That seems to be a major part of the story, yeah.
And even in sectors where Europe has traditionally been strong, like pharma, the report points to some serious challenges.
That's right. I mean, the EU's pharmaceutical sector still leads globally in trade measured by value, so that's good.
Okay.
But it is losing market share in the really dynamic segments like orphan medicines, drugs for rare diseases, and these advanced therapy medicinal products, the cutting-edge gene and cell therapies.
So losing ground on the future stuff, why is that happening?
Well, the report highlights a couple of key reasons. First, money. Total EU public R&I spending on pharma is less than half the U.S. level.
Half.
And private R&I investment is only about a quarter.
Ouch.
But it's not just about the money. The regulatory framework for medicine approval, it's slow and complex. A median of 430 days in the EU versus 334 days in the U.S. back in 2022. That's a significant delay.
Nearly 100 days longer.
Yeah. And then there's fragmented access to health data. Because the GDPR, the data protection regulation, is applied unevenly across member states, it hinders innovation, especially for AI applications in pharma, which really rely on large, accessible data sets. It just slows down bringing new treatments to patients.
Okay, so you've got productivity lags, digital gaps, trouble scaling up, even challenges in strong sectors like pharma. What does all this mean for Europe's workforce? Its ability to actually keep up with these shifts? Let's talk about bridging the skills chasm.
Yeah, and the report paints a rather stark picture here. Persistent skill shortages across Europe.
How bad is it?
Approximately one-quarter of European companies report significant difficulties finding employees with the right skills. Another half report at least some difficulties.
So three-quarters are struggling to some degree.
Pretty much. And what's particularly alarming, 77% of EU companies say even their newly recruited employees lack the required skills.
Wow, even the new hires aren't ready?
Apparently not fully. And it's
Wow.
not just frontline workers. The report says skills are also lacking at the managerial level, which, likely contributed to that sluggish ICT adoption we talked about. Managers didn't push it, maybe didn't understand it.
Right, that makes sense. And these skills gaps are hitting at the worst possible time because of Europe's demographic headwinds.
Okay. Exactly. The need to address them is particularly acute because, as we mentioned, the EU's labor force is projected to shrink by close to 2 million workers each year by 2040,
Unlike the US.
unlike the U.S. population, which is projected to expand. So Europe needs more productivity from fewer workers, and skills are key to that.
Which leads, I guess, to talent drain.
It seems to contribute significantly. Look, Europe produces high-quality STEM talent, science, technology, engineering, maths grads,
We know that.
but the supply is limited. About 850 STEM graduates per million inhabitants per year. The U.S. has over 1,100.
Quite a difference.
And then this talent pool is further depleted by brain drain overseas. These highly skilled people often find more, and frankly better, employment opportunities elsewhere, mainly the U.S. It's a serious long-term vulnerability for Europe's competitive edge.
And digging deeper into skills, digital preparedness seems like a major concern.
Huge concern. Almost 60% of EU companies report that a lack of digital skills is a major barrier to investment.
60%.
And a similar share struggle just to recruit ICT specialists. The report also notes that around 42% of Europeans lack basic digital skills. That includes 37% of the actual workforce.
That's a massive segment of the population not really equipped for the modern economy.
It is. And despite significant financial commitments, the EU is spending money on this. The report indicates ineffective skills investments.
So the money isn't working.
Well, results have been limited, despite EUR 64 billion spent on skills under the current EU budget.
Why? What's going wrong?
It seems to be down to a lack of coordination among member states, not enough industry involvement in defining what skills are actually needed.
Ah, so asking the employers.
Right. And a lack of systematic evaluation, or what the report calls skills intelligence. Basically, reliable, up-to-date data on what skills are needed where and whether the training is actually working. And this really raises an important question about systemic issues, doesn't it? Europe's fragmentation isn't just about, say, economic policy. It seems deeply embedded in how it leverages its human capital and its technological potential, too.
Okay, let's zoom in now on some specific sectors where Europe faces these critical challenges, but maybe also some unique opportunities. First up, energy and decarbonization.
Right. And, while energy prices have fallen from those crazy peaks we saw,
Thankfully.
the reality for EU companies is still pretty challenging. They're still facing electricity prices 2 to 3 times higher and natural gas prices 4 to 5 times higher
Yeah.
than competitors in the US and China, respectively.
It's still that big gap.
Yeah. And this disproportionately hits those energy-intensive industries, think. Chemicals, steel, cement, which form the backbone of a lot of Europe's manufacturing. They account for 16% of total manufacturing gross value added. It just makes them inherently less competitive globally.
And then you layer on the carbon costs. The EU is, well, unique globally in having a significant CO2 price through its emissions trading system, the ETS.
Vital for decarbonization, absolutely.
But it adds cost, right?
Yeah.
Especially for those energy-intensive industries whose greenhouse gas emissions are like 5 times higher than total manufacturing.
Exactly. And the Carbon Border Adjustment Mechanism, the CBAM, which is meant to level the playing field by taxing carbon-intensive imports.
Right, put a price on embedded carbon from outside.
Yeah. It's being implemented now, but its success is still uncertain. It's complex, and there are worries about fragmented implementation across the EU.
And another major bottleneck for the green transition seems to be permitting obstacles.
Oh, absolutely. The report points to excessively long and uncertain permitting processes for new power supply, like wind and solar farms, and also for the grids needed to connect them.
How long are we talking?
Well, for example, onshore wind farm permits can take up to 9 years in some member states,
9 years.
compared to under 3 years in others. That kind of delay drastically slows down the deployment of renewable energy infrastructure. You just can't build fast enough.
And I guess this feeds into the problems with clean tech manufacturing being under pressure.
It certainly contributes. Look, the EU is the second largest market for solar panels, wind turbines, electric vehicles. Huge demand here, but it has lost significant manufacturing capacity in solar PV, mostly to China. And it's facing increasing challenges in wind power equipment, too. The EU's market share in global wind turbine assembly fell from 58% in 2017 down to 30% in 2022.
That's a dramatic drop. Why?
Well, the report suggests many EU companies actually prefer to produce in China because of higher construction costs here in Europe, those permitting delays we just talked about, and also restricted access to critical raw materials needed for the turbines.
And the automotive transition challenges. That's another key example of this strategic dilemma, isn't it?
It really is. The EU has this very ambitious target, zero tailpipe emissions by 2035 for new cars.
Which basically means phasing out internal combustion engines.
Effectively, yes. But the report notes there hasn't been a really synchronized push to convert the entire supply chain. The battery makers, the component suppliers, everything.
While China,
by contract, has strategically focused on building out the full EV supply chain since way back in 2012. They've invested massively. Estimates are EU are 110, 160 billion by 2022.
huge sums.
And they're now considered basically one generation ahead in EV technology and at a lower cost.
And we're seeing the results.
We are. Chinese car makers' EV market share in Europe rose to almost 15% in 2023.
15% already.
While European car makers' share in their own EU EV market fell from 80% down to 60%.
Wow.
And of course, charging infrastructure, still a bottleneck, hindering widespread EV adoption for consumers.
So, okay, it's really not just about Europe setting ambitious goals, but also about securing the fundamental building blocks to actually achieve them, which brings us neatly to critical raw materials, or CRMs, and strategic autonomy.
Exactly.
The report highlights absolutely exploding demand for these materials: lithium, cobalt, rare earths, etc., driven by EVs, batteries, wind turbines, all the clean tech.
Yeah, the market size for critical minerals just as the energy transition doubled in the past 5 years, reached EUR 300 billion in 2022.
Doubled in 5 years.
And lithium demand, just as one example, tripled between 2017 and 2022. Tripled.
Incredible demand growth. But what about the supply?
Well, that's the problem. Despite increasing investment globally, an adequate future supply is far from assured. And the EU, well, it lacks a comprehensive strategy covering all the stages of the supply chain, from exploration and mining right through to processing and recycling.
So it's piecemeal.
It largely relies on private actors and markets, which is quite different from China, which has pursued deep vertical integration, controlling the whole chain,
Right.
or the U.S., which is now offering substantial government support, like through the Inflation Reduction Act. This creates significant supply vulnerability for Europe in these absolutely essential materials.
And even where there is some domestic potential, the report mentions lithium deposits in Portugal, for example.
There are deposits, yes.
There are major bottlenecks getting them out of the ground.
Exactly. Permitting processes again. For new mines in the EU, they are painfully long. The report says they can be 3 to 5 times longer than the desired targets set out in the EU's own Critical Raw Materials Act.
3 to 5 times longer.
Yeah. And while recycling has significant potential, I mean, it could meet a large portion of Europe's metal requirements, maybe over half to 3/4 by 2050.
That's huge potential.
It is. But it faces obstacles too, like higher costs for secondary recycled raw materials compared to primary ones, and just a lack of investment in the necessary recycling infrastructure across Europe.
Okay. Finally, in this section, let's touch on defense and space.
Right. 2 strategically vital areas. The EU defense industry, well, it suffers from decades of underinvestment and now depleted stocks, partly due to support for Ukraine.
And spending is low.
Aggregate EU defense spending is still just 1/3 of U.S. levels. And a lack of coordination between member states leads to duplication, inefficient spending. It really hinders economies of scale, everyone buying slightly different things.
The classic European fragmentation problem.
Exactly. And in the space sector, despite having world-class strategic assets like Galileo and Copernicus,
Yeah, those are big programs.
the EU has actually lost its leading market position in commercial launchers, think Ariane rockets, and also in geostationary satellites. It even had to temporarily rely on SpaceX, a U.S. company, to launch some of its Galileo satellites. That's a significant strategic dependency.
Relying on Musk for strategic assets.
Basically. And public expenditure on space reflects this. USD 15 billion in 2023 for the EU, compared to the US's USD 73 billion.
Big difference.
And it's projected to be overtaken by China's spending, maybe USD 20 billion by 2030, What's more, the European Space Agency's geographical return
Oh,
principle.
yes. Explain that.
It basically means that funding contributed by a country has to flow back to industry in that same country, sometimes even if it's not the most efficient or best industrial choice for the project overall.
So it guarantees work share, but potentially fragments industry.
Precisely. It further amplifies this industrial fragmentation. And all this really raises a critical question. How can Europe overcome this deep-seated fragmentation and actually start to strategically invest in its future, not just economically, but also in terms of security and supply chain resilience?
Okay, so the report paints a challenging picture, no doubt. But it isn't just a diagnosis of problems, it does lay out a comprehensive plan for Europe's future. And it starts with a truly bold vision for investment, mobilizing massive investment.
The scale of the need here is, well, it's unprecedented, frankly. To meet its climate goals, its digital goals, its security need, Europe needs an additional minimum annual investment of somewhere between EUR 750 to 800 billion
Per year.
per year. That's about 4.4 to 4.7% of EU GDP. This would raise Europe's total investment share from around 22% today up to 27% of GDP. Those are levels last seen way back in the 1960s and 70s.
Wow. To put that in perspective.
Well, think about the Marshall Plan after World War II.
Yeah.
Hugely famous, right? That provided about 1–2% of GDP annually to rebuild Europe.
So this is potentially double or triple the scale of the Marshall Plan year after year.
In terms of the annual percentage of GDP needed, yes. We're talking about a multi-generational investment push. It's massive.
That's an incredible target. But the report points to a significant funding gap. You mentioned earlier, EU households have ample savings, EUR 1,390 billion in 2022, much more than in the US.
That's right, huge savings pools.
But these savings are just not being efficiently channeled into productive investments within Europe. Why is that? What's the blockage?
The report highlights a key structural reason. Europe relies excessively on bank financing. Now, banks are great for traditional businesses, lending against collateral,
Sure.
but they're often less suited for the riskier, longer-term bets required by innovative projects, by startups, by scale-ups.
The kind of things needed for the future economy.
Exactly. And Europe's banks themselves, well, they face lower profitability and significant fragmentation compared to their U.S. counterparts. Just think. The largest U.S. bank, JP Chase, has a larger market capitalization than the 10 largest EU banks combined.
10 combined.
Wow. It's a structural issue of how capital flows, or rather doesn't flow efficiently into these growth areas.
And the EU budget constraints add to this challenge too, presumably.
They do. The EU's annual budget, as we know, is relatively small, just over 1% of EU GDP.
Tiny compared to national budgets.
Right. It's also fragmented across nearly 50 different spending programs, making it hard to create real strategic focus. And frankly, it lacks sufficient risk appetite for mobilizing large-scale private investment. Plus, looking ahead, the upcoming repayment of the EU borrowing under the Next Generation EU Recovery Fund, that starts in 2028 and will account for about EUR 30 billion per year.
So less money for new things.
It will further stress the budget's capacity for major new initiatives, yeah.
Okay, so given this monumental investment challenge, what are the proposed solutions? How can Europe find this extra 800 billion euros a year?
Well, the report proposes a multi-pronged approach. A big one is building a genuine capital markets union, the CMU.
We hear about that a lot. What would it actually do?
The goal is to make it much easier to raise capital equity, debt across borders within the EU, break down national barriers. A key part of this, the report suggests, is transforming the European Securities and Markets Authority, ESMA, into a single common regulator for all EU securities markets.
Like the SEC in the US.
Sort of, yeah. Streamlining rules and oversight across the board. It also recommends finding ways to channel those large household savings more efficiently into the economy. For example, through well-structured second-pillar pension schemes, which typically have a longer investment horizon and can invest more broadly in things like infrastructure and venture capital.
Okay, unlock the savings.
And on the EU budget side, it suggests improving its focus and flexibility, maybe regrouping some of those 50 funding programs, increasing the size of things like the Invest EU Guarantee Scheme to unlock more private investment.
Using public money to leverage private money.
Exactly. And finally, it suggests the issuance of common safe assets, basically. EU bonds building on the successful next-generation EU model. These could be used to fund specific joint investment projects and would provide a stable, liquid investment vehicle for global investors.
Interesting. But the report makes clear investment alone isn't enough, right? It stresses the need for fundamental changes in how Europe governs itself and regulates its economy. This is where governance and regulatory reform comes in.
Absolutely critical. Currently, the report says, EU countries are responding to this new, challenging environment in a pretty fragmented way,
No surprise there.
which clearly hinders collective effectiveness. You see uncoordinated national industrial policies, for instance, leading to duplication, maybe incompatible standards, and even distortion of the single market as countries try to lure investment. There's just a clear lack of coordination and financing instruments and across various policies. Europe isn't speaking with one voice or really moving in one strategic direction.
And for businesses on the ground, the regulatory burden is cited as a massive hurdle.
Huge. Over 60% of EU companies see regulation as an obstacle to investment.
Over 60%.
And 55% of SMEs, small and medium-sized enterprises, the backbone of the economy, cite administrative burden as their single greatest challenge.
Just the paperwork and bureaucracy.
Yeah. The report even points to concrete examples of duplication and inconsistencies across EU legislation, finding 169 duplications across just 13 EU laws. And then you have fragmented national transpositions, like we mentioned with GDPR, making compliance a complex, costly patchwork.
So what are the solutions proposed here? How do you fix governance and regulation?
Well, the report advocates for reforming EU governance to increase coordination and, crucially, reduce that regulatory burden. One big suggestion is extending qualified majority voting, or QMV, in the Council.
Moving away from unanimity.
Exactly, for certain policy areas. This would allow decisions to pass with a set majority, rather than requiring every single country to agree, which would significantly speed up crucial policy changes.
Which often get blocked by one or two countries now.
Precisely. And if QMV is blocked, the report suggests utilizing enhanced cooperation, allowing groups of like-minded member states to move forward on specific initiatives.
Sort of a coalition of the willing.
Kind of. It also proposes streamlining the EU's existing body of rules, its acquisite, that entire legal framework built up over decades. Systematically assessing and codifying existing regulations, maybe starting with the most economically exposed sectors, trying to simplify.
Gate spring clean of EU law.
Something like that.
Yeah.
And finally, it suggests practical things like appointing a commission vice president specifically responsible for simplification, and improving how regulatory impacts are assessed before laws are passed, particularly focusing on the impact on SMEs and small mid-caps, to ensure new rules don't inadvertently stifle growth. You know, if we connect this back to the bigger picture, it really is about shifting from this historically fragmented approach to a truly unified strategic European approach. But this raises, I think, a really important question. Can Europe actually summon the political will to make these deep, sometimes difficult institutional changes? Because the report argues they are necessary to fully leverage its collective strength.
That is the multi-billion euro question, isn't it?
Mm-mm.
Okay, so to try and tie all this together, what are the big levers the report says Europe needs to pull? Let's quickly run through the key action areas and the sort of synthesized recommendations, starting with innovation and research.
Okay. The report calls for doubling support for fundamental research through the European Research Council, the ERC, launching a new ERC for Institutions program to foster world-leading research hubs, not just individual researchers.
Build centers of excellence.
Yeah, creating prestigious EU chair positions to attract and retain top global researchers, and developing a European RRP-type agency modeled on the US's DARPA to really back high-risk, high-reward breakthrough innovation.
Okay. What about skills development?
Here, it's about overhauling the whole approach, enhancing the use of data for skills intelligence. So, really understanding exactly what skills are needed, where, and when. Making education and training systems much more responsive to those evolving needs, critically by involving employers much more closely.
Ask the companies what they need?
Right. Introducing a common EU certification system so skills are recognized across borders. Launching a specific tech skills acquisition program to actively attract tech talent from outside the EU. And reforming vocational education and training, VET, systems.
Got it. Energy decarbonization.
Key actions here. Lower energy costs for end users, partly by reinforcing joint procurement for LNG, like the EU started doing, and promoting long-term contracts to stabilize prices. Accelerate decarbonization through a technology-neutral approach. So, embracing renewables, yes, but also nuclear, hydrogen, carbon capture backed by massive finance, and those crucial accelerated permitting processes for new installations.
Speed things up.
And ensure a global level playing field for Europe's energy-intensive industries. Measures like strengthening the Carbon Border Adjustment Mechanism, CBAM, and adapting state aid rules to support green investments.
Makes sense. How about strategic autonomy, particularly on those critical materials?
Implement a truly comprehensive strategy for critical raw materials, covering the whole chain from mining and processing right through to recycling. This includes creating a dedicated EU critical raw material platform for things like joint purchasing and managing strategic stockpiles.
Buying together, like with vaccines or gas?
Potentially, yeah. And for other strategic industries like semiconductors, launching a common EU strategy focused on innovation funding, building testing labs, and supporting Europe's fabless companies. The chip designers, perhaps via a new, faster, fast-track IPCEI, those important projects of common European interest.
Streamlining the big projects, okay? Defense and space.
Here, the push is for swift implementation of the new European Defense Industrial Strategy, EDIS, and the Defense Industry Program, EDP, increasing the aggregation of demand so countries buying kit together in joint defense procurement, enabling industrial consolidation in the defense sector where it genuinely increases scale and efficiency, and reinforcing European principles in procurement, buying European where possible.
And spacey.
Key recommendation. Remove the European Space Agency's geographical return principle, that fragmentation driver we discussed. Establish a functioning single market for space through a common EU legal framework. And of course, increase funding for research and innovation in space technologies.
Right. And finally, transport and connectivity.
The big one here is realizing those massive investments needed for the Trans-European Transport Network, the TEN-T, to complete missing links, rail, road, waterways. Accelerating digitalization across all transport modes, launching dedicated EU innovation projects using public-private partnerships, and developing a coherent international connectivity strategy, thinking about infrastructure links beyond Europe's borders.
Wow. That's quite a list.
It is. And what's really striking, I think, is the sheer ambition, but also the interconnectedness of all these proposals. Success in one area, like improving skills, can unlock massive potential in another, like boosting clean tech manufacturing or strengthening defense capabilities. It's presented as a truly holistic vision, but one that absolutely demands collective political will across the EU.
That really brings us towards the end of this deep dive. We hope we've managed to provide you with a clearer, more informed picture of Europe's current challenges, but also the incredibly ambitious path forward that's laid out in this comprehensive report.
Yeah, Europe faces a truly monumental task. It really requires a shift from, incremental adjustments and muddling through towards truly transformative collective action across all levels, EU, national, regional, which I guess leaves an important question for you, the listener, to ponder. Considering everything we've discussed today, the external pressures, the internal hurdles, the proposed solutions, what single area do you believe is the most critical for Europe to succeed in? If you had to pick one priority to truly secure its competitive future, what would it be and why? Something to think about.